So you might not notice them in a bull market, but in a downturn, defensive stocks could be the reason why you sleep better at night. This is stock number 5 in our 7-day series, showing you how to start investing in companies around you. And today's company is in all our bathrooms. Colgate. So here's how StockOracle ranks the company on our 6 key matrix: predictability, profitability, growth, economic mode, financial strength, and valuation. We'll talk more about it later on. Now, many investors get caught up chasing the next growth story, loading up on high-risk plays in the hopes of getting outsized returns. But we often forget that investing is a marathon, and that's where defensive stocks come into the picture. And these are companies with products where people buy no matter what the economy is doing, providing stability when markets actually turn volatile. So using StockOracle, here's how we can look at Colgate today. So let's look into this company Colgate and how it actually stacks up in StockOracle. Let's key in the ticker symbol CL, and we will be greeted by this dashboard over here. And on the right hand side, you can see that this is how the Oracle IQ chart actually looks like for Colgate as a company. We are noticing a lot more yellow and orange flags in the company. But that said, I think it's also important to bear in mind the type and the category of companies that you're researching into. So specifically for Colgate, I think they fall under the consumer defensive space, and they are like considered staple companies. So meaning to say, they are less susceptible to a lot of all these economic market cycles. And specifically, a lot of all these companies are being positioned during recessionary times to being the defensive stocks, and they are able to stabilize your portfolios. And specific for this genre of companies, we must have them both predictable and also profitable. That's why they can weather any storms ahead. So I think moving on from here, I think you have to keep on the investment lens. They are looking at a consumer defensive company. But by saying so, does not mean that we give a discount in terms of the quality of the company, their moat, and their valuation. No, I think all those still applies, but I think the key focus here is really on the predictability and the profitability segment here. So now let's look at the company overview. I'm looking at their historical growth rates, what are the distributions. You can see that pet nutrients makes up a very small percentage, roughly 22%, while the rest of it actually comes under the oral, personal, and home care segment. By geographic region, similarly as a defensive company, we want them to be hugely diversified so we don't have any particular geographic region concentration risk. For Colgate, I think they score very well in this particular segment. They have a very big footprint across the world. So moving on to their financials, I'm looking at their top line growth rates. Not the best growing company out there. In fact, that's why it's being flagged out in the Oracle IQ chart as having low estimated projected earnings or growth rates. But that's it, still profitable. Operating cash flow did kind of took a hit in 2022, but remained relatively stable. And specific to their balance sheet, their total debt when compared to their operating cash flow, I think it's roughly 2.2x. So I think still okay, still pretty healthy, but just to analyze the company and to take you through the thought process, looking at the margins and especially the profitability ratio, it is slightly all over the place, but I think even at a 20-30% ROIC, I think it's still pretty healthy. Now moving on to their moat, just to have a very quick AI moat analysis, understanding Colgate as a company. So we do understand that Colgate actually operates in a highly competitive consumer goods industry, and their main competitors includes Procter & Gamble, Unilever, and Johnson & Johnson. So specific to the 5 key criteria when estimating the economic moat, they clearly don't have network effects, you don't have to use their Colgate in order to use their toothbrush and things like that. There's very little switching cost. People can switch over to their competitors easily, and I don't think there's very high barriers to entry. Maybe they have to figure out the logistics chain and to expand internationally, but I think a lot of the other competitors in this space all have very globalized and very sophisticated networks. But that's it. I think there is still a certain level of economies of scale for them to spread across their different product lines and specifically in that segment, and also a certain level of brand loyalty and pricing power. When thinking about Colgate, you immediately think about their toothpaste. So there is that brand recognition there, but is it enough for them to charge a premium pricing over their competitors? That I'm not too sure. So before putting in any real money into the company itself, I think it's important for you to have a better appreciation of the entire landscape in the whole consumer defensive space. And like any investor, we always want the bang for our buck. We don't want to just buy companies that are undervalued, we want to buy the best in class. So in StockOracle, actually you can go in under the compare function and they automatically populate some of their key competitors competitors in this whole consumer defensive space, comparing it to Procter & Gamble, L'Oreal, Unilever, and Kimberly-Clark, so on and so forth. And scrolling down, I think you can see this particular trend where looking specifically in these type of companies, they tend to rank pretty high on both profitability and predictability, which is the first two criteria on the Oracle IQ chart. And clearly when looking at companies like Estee Lauder, for example, even though they're in the same space and it's a comparable company here, they actually rank very low in the first 3 points, which is predictability, profitability, and growth. But I think all things considered, when looking across many of these different defensive stocks or defensive names, it's important for you to dive deeper into them and to look into companies that potentially could be a better candidate compared to Colgate himself. And just by scrolling through and looking across the different Oracle IQ chart, you probably have a better understanding across this sector as well. And of course, last but not least, after understanding the quality of the company and comparing it across their competitors, you have to pay attention to the valuations as well. So you can naturally go to the intrinsic value tab and to see the distribution of the different estimates of the intrinsic value of the company today. And the Oracle value calculated by the platform itself can serve as a very good benchmark or first step. And I hope that through this very short sharing, you have a better appreciation of how to use StockOracle to harness your own investment research. By now, you should have a better appreciation of defensive stocks. So there are businesses whose cash flow actually holds up when the economy wobbles. They sell essentials, enjoy steadier demand, and usually they do convert a large percentage of their earnings into cash. And in a portfolio, they soften drawdowns, actually stabilize returns, and keep dividend income flowing so you can stay invested and sometimes even rebalance into weakness. So there are some rule of thumbs to consider when considering companies with such profiles. So look for inelastic demand, recurring purchases, and the ability to pass through costs without losing customers. You probably want to also favor simple balance sheet, consistent margins across cycles, and long records of paying and covering dividends from free cash flow. So global reach definitely helps, so does brand or distribution strength, because both of them actually reduce reliance on a single market. Of course, not forgetting that defensive stocks isn't the same as being risk-free. Some of these stocks actually barely move in a bull market, and others can still get hit by rising costs, cheaper competitors, or currency swings. So look at them like any other businesses that you include into your portfolio, and paying too much for stability will also mean that you're asking for trouble. That's why it's important to know exactly why you own it in the first place. And we did exactly this exercise just with a few clicks in StockOracle. You can use defensive to steady the portfolio, know why you own them, pay a fair price, and keep an eye on whether the economic mode and cash generation still match the role you assigned them in the first place. And if you want to get access to this investing tool, you can head down to the link below to check out our latest offer. And this is CK from Piranha Profit signing off. Till next time, keep winning.